update just happened in the United States, and it is the credit rating. Okay, it's done by Fitch, and I think it's long overdue. Okay, the last time this actually happened was back in 2011. Okay, it was done by S&P, Standard & Poor, and when that actually happened, it wiped out indexes by about 6% or so in the day itself. Okay, but of course, the day that we actually got the news, which was yesterday, as of this recording, yesterday, we fell about like an odd 2% or so. It wasn't really that crazy, but we're starting to see a little bit more of a slide as well. Right now, we're in the pre-market, and the Nasdaq is still down about half a point. Okay, half a percent. My bad. But anyway, I do think that this is personally long overdue. I do think that, especially with the whole entire debt crisis that we actually have been happening, and it started snowballing in 2021 as well, because a lot of the debt that actually been accrued by the United States happened mostly in 2021 and 2022. Okay, and of course, in order for you to also pile up into this mountain of rubbish, okay, we also had this whole entire banking crisis with Silicon Valley Bank, with Signature Bank, with all these different banks that had imploded in the United States earlier this year. Okay, and of course, let's just put a cherry on top of this whole entire situation as well. We had 78 debt ceiling extensions since 1960. Right now, it's sitting at a very comfortable level of $32 trillion worth of debt. Okay, so I don't know. Okay, sounds like a lot of rubbish to me. Okay, but anyway, you kind of have to also compare it to all the different AAA rated countries out there. Okay, so right now, if you think of AAA, you think of Denmark, you probably think of Germany, you probably think of Singapore, my home country, Sweden, and so on. Okay, usually the debt to GDP ratio right now, on average, is sitting about 40% or so. Singapore is very, very high, but there's a different system of how we actually do the debt in Singapore. But that's for another video if you're interested in that. But anyway, for the whole entire countries that is holding AAA ratings right now, they're roughly going to be sitting about average of 40% debt to GDP ratio. Okay, so if you want to actually put a comparison to America into this whole entire thing, okay, right now America, they're sitting at 110% debt to GDP ratio. 110-ish, I think. And they are actually on their way to 118% debt to GDP ratio by 2025. So personally, I think that this downgrade coming out by a major credit rating firm did not really surprise me. Okay, if anything, I think this kind of makes more sense. The market has been just blindly bullish, especially for the three different reasons that I actually talked about on why the market continued to go up. The first reason in this year, of course. In this year, the three different bull runs, the first was supplied by the people who had a lot of FOMO. A lot of people who did not manage to buy in on the dip of 2022. And then everyone basically just feel like they're missing out. They wanted to buy more into the companies that they love. And then they just started buying in and buying in and buying in. That was the first bull rally. The second bull rally for the tech industry was during the banking crisis that I spoke of earlier. The banking crisis created this sort of change in mindset for a lot of people. Because banking used to be one of the industry that is untouchable. Of course, we cannot forget what happened in 2008. But people tend to forget, and people would always think that banks are usually the industry that does not fall. Banks are usually the industry that's going to be good. So they invest into banking stocks. But of course, with the banking crisis that actually happened earlier this year, a lot of people basically took all the money out from their banking stocks and flushed it all into tech stocks. Okay? And that's going to be your different fintech stocks, it's going to be your tech stocks, it's going to be your automobile tech stock, you name it, okay? It's going to be a Tesla, okay? It's going to be your social media companies, it's going to be your PayPals, it's going to be your chips manufacturer. So of course, a lot of money inevitably went into tech stocks. Now for the third and final bull run that is still happening right now effectively, is from the AI boom. So, of course, a lot of people, I think the AI boom rally was pretty much rallied up due to the fact of FOMO as well. It's kind of similar to what happened back when we had the whole metaverse situation. Any company coming out to say, yep, we intend to use a metaverse for the next quarter. We intend to research and do some development for the metaverse for our company. We intend to have this new different payment system for our company. All these different companies basically just went 30% upwards whenever they give out those kind of announcements back in 2021. So today, for all the AI companies, as long as you talk about AI, you just talk about how you intend to use AI into your work scope, use into your work cases, into your different creating models, creating any sort of creatives in general, you're gonna get 10% rally. That's where all the money is going. Everyone is just pumping money into AI stock. But you must understand, the real winner of an AI rally are not companies talking about the actual AI. It's the companies that's manufacturing the chips to do AI. Nvidia is up a whopping 300% year to date. Okay? And I think that they can most likely go even higher. You never know. Okay? Which is why I'm telling you, this rally is a little bit uncalled for, especially with all this different shortcoming that we really have been getting. But of course, I do want to also explain this to you because I am inherently bear in this current market, but I do have bullish views in certain areas. So I don't want you to think that I'm just biased based on whatever that I invest in. Just because I'm a bear does not mean that I just see everything as just ominous and I think everything's just gonna go bankrupt, everything's gonna go to zero. I don't think that's gonna be the case. Okay? So, but anyway, that's beside the case. So now, what happened with this downgrade? A news actually came out yesterday. Okay? President Biden himself came out to say that, that's ridiculous. Why would you even downgrade our credit rating? It doesn't make sense. And even the Treasury Secretary Janet Yellen herself came out to call the downgrade arbitrary and outdated. But of course, basically what she's trying to say is that the economy at this current moment is not what we actually have back in, say, the 2000s. Okay. A lot of these different old metrics for you to actually rate these different credit systems are a lot different today. Okay, the economy can be really, really resilient. A lot of people are having 2 jobs, whereas back then a family only had one person doing 1 job. Right now, every family have people doing 5 jobs basically. Okay, there's going to be a lot of different metrics for you to actually count on how resilient a economy is. And of course, last time back in 2011, when this actually caused this huge down movement of 6%, like I mentioned before, right now we're not really looking that big of a sway in the market movement. But I do think that it's going to be taking a little bit more time for the market to actually realize that this is actually quite a bad thing. Because right now, we're not waiting for investor to actually make the move to, upgrade, downgrade, any sort of thing. It's not up to the investors. It's actually up to the companies on what their next move would actually be. So yeah, of course, I think after this whole entire downgrade, it's kind of interesting to see that the Nasdaq actually fell only 2%. Personally, I thought a downgrade from a AAA credit rating down to a AA plus, I was expecting about at least a 4% or so. But yeah, of course, I think a lot of the analysts actually came out to say, 2% is considered a lot as it is. They are expecting about 1% or so. So yeah, kind of interesting, I guess. But in the pre-market right now, the Nasdaq is down almost like 0.6%. So hey, it is what it is. But anyway, now that's kind of bring us to what the new problem that we actually have today, which is treasuries. Okay, so for people who don't really understand the basics of what treasury is, I'm going to be explaining it to you in a very layman and very basic form in hopes that you actually understand this. But of course, do understand that this is not exactly how it actually works. This is just simpler for you guys to actually put it into context. Okay, so just think of treasuries as bonds. Okay, it's a bond that gives you a set percentage of yield, and when there's more buyer, the lower the yield, because that means that you actually put into supply and demand sort of thing. A higher demand will actually lower the supply effectively in terms of yield. Okay, and of course, when there's more sellers of these treasuries, then the yield would usually be higher. Okay, because they kind of want to be competitive. People who are trying to sell it, people will say, okay, you know what? screw 3%, I'll give you 3.5. And then someone will say, okay, you know what, he's doing 3.5, I'll do 4. That sort of thing, until someone actually buys it. Okay, so treasuries in general has always been overbought in the market, okay, because interest rate continues to rise up, especially in the last couple of years. Interest rates went up to like what, 5.5% as it is. And that kind of create a lot more increment to happen in the yield for treasuries. Because of course, with higher interest rates, it only makes sense for your treasuries to actually match it or be even higher. Okay? And that's kind of how it is for inflation as well. Because what the whole point of interest rates being high is for them to actually combat inflation. Okay, so of course there's going to be a whole other argument that inflation is not going to be long-term 2%, which I think is a very valid argument, but I think that's argument for another day. Okay, let's just put that aside. Okay, but yeah, right now I do think that with this current obscene amount of supply in treasuries, it can only be supported with this, well, relatively high rates of interest rates by the Federal Reserve as well, and because that's kind of how Treasury can actually give out this sort of competitive rate. And I just thought, like if this long-term inflation argument actually do come true and it's not 2%, it somehow goes up to like say 3%. Okay, let's just say it just stays at about 3% or like 2.8% or whatnot. There is a good chance that treasuries in the long run would actually go up as well. Okay, and then that would actually spur for interest rates controlled by the Federal Reserve to go up as well, and it will be higher for longer. So yeah, that's kind of how interesting a credit rating downgrade can actually create this sort of different scenarios. And we're not even near the end game at the moment. Right now we're just starting. Okay, right now you are just talking about treasuries. You need to wait till companies actually start taking actions, and then employees start to get affected. Then you would actually see where this whole downgrade actually would go down in history. But of course, it could be the start of a brand new bull run where people just buy in on this dip because they think that, oh, you know what, I think I missed on the dip. I should get into this bull market before it's too late. But at the same time, you can also argue that this could be the bear market that actually goes down 10% in the indexes. We will never know. But anyway, that's all I have for this video. I think it's going to be a very, very interesting year for us to actually look at it. But anyway, that's all I have for you guys. But anyway, thanks you so much for watching, and I'll see you guys in the next one.